Welcome out to Trading Justice podcast number 585. I'm excited about our conversation today. Matt and I are going to do a mid-year review. He wrote about this topic in our tackle trading newsletter, which we like to say is the just such a perfect reason to become a pro member today. But we're going to walk through the different areas of the market, grade them, talk about them. I love these type of conversations, Matt, because it allows us to both review and preview what we might want to do in the coming months. So looking forward to that conversation. But before I say hello to you, Matt, and before we get going on anything else, I want to give a shout out to Tackle Trading, the sponsor of this podcast. And Tackle Trading is having its mid-year annual sale, 4th of July celebration, where all of the products are on sale. Matt, hello, and tell me a little bit about the sale going on at Tackle Trading right now.
Hello to you as well, my friend. Every 4th of July, we do a holiday sale season where we put all of our premium systems, all of our annual subscription products, coaching as well. They go on discount for our community to get their educational needs dialed in, and it's a great way to set up your educational track for the rest of the year. And I did talk about it in the Tackle Trading newsletter a little bit, but I talked from a perspective of what my mentors taught me along the way and how it helped shape who I was as a trader. And so it's definitely educational season for us at Tackle Trading, and it's a great time to get your pro membership dialed in. It's a great time to get the annual membership at Tackle Trading, so you don't have to worry about a monthly cost at all. And it is a beautiful time right now because after this holiday sale season, the pro membership is going to have a slight price increase. And so it's a good time to get that locked in because we grandfather in all pricing from an annual or a subscription perspective. So definitely check it out. And obviously you can go over there to tackletrading.com, hit the storefront, and you can see all those products, all those systems. And if you want to sign up for a 30-minute consultation, you can do that. If you scroll down a little bit to the coaching program, you see a link that says schedule consultation. You can actually set up a 30-minute consultation with one of the Tackle Trading coaches to review where you're at right now and to start putting a plan in place to get to where you want to go in the future. And so really good time and opportunity to focus on your educational needs. And there's no better place than Tackle Trading as the #1 educational resource in America today, according to Trustpilot.
Yeah, I know. I mean, one of the things that we do well at Tackle Trading is educate while we navigate markets. It really separates us and it's a very unique business, one that you will enjoy, be proud to be part of the community. It's an amazing community.
I'm glad you bring that up, Mark, because a lot of times you get some decent education out there. A lot of times you get some decent application analysis out there. But what separates us at Tackle Trading and the content that we produce for our pro members is we like to educate while we analyze.
It's very unique. It's a very unique offering that we offer.
Well, you don't have to go too far just to understand what we do in the newsletter, because that's what we do every single week in the newsletter. We break down the market this week. We make sure our community understands what is happening in the market this week from an overall data perspective, from a news perspective, but we always do it from an educational perspective. For example, Mark, I was writing this week in the newsletter about the technical update of the market. And what I decided to do, instead of just identifying what the trend was, what the pattern was, where support and resistance were, I did that. Of course, I did that. But I did it in teaching the concept of when you want to be aggressive in confirmation versus when you want to be conservative in terms of confirmation. And so we're always going to put the education in front of application. And it really does help our community understand not just the when to take some action, which everybody wants to get, but the why you want to take action. And so we really want to strive to make sure our community has all the information necessary to navigate the financial world on a day in, day out basis, on a week in, week out basis. And we want to make sure that they have the full understanding of why they should take certain actions in the market.
Yeah, I know. I've always thought of tackle trading as this: we teach you to fish. We don't just give you the fish, but we teach you to fish along the way. And it's just
That's certainly true.
and so Matt, I'm excited about the podcast.
Mhm.
I'm excited about the podcast because I like these type of activities where we analyze a cross section, analyze why it did a certain thing, and it just by its nature it gives you the all right, what's coming next. It allows you to have a really nice conversation from just a broad market, areas of the market, commodity. I enjoy these type of conversations, and enjoyed reading in the newsletter because it gave me some prep time to say, I think you're a little off there, brother.
Well, and that's the
See, I
conversation
know
I want
what
to have.
you're going to say because I read the newsletter in the
Yeah.
podcast. You don't know what I'm going to say.
You know my letter grades.
Yeah,
That is accurate. I do not know how you will agree or disagree with the way I graded the market, but Chucky, I'm excited for this conversation as well because who doesn't love grading something?
like it's just for market geeks, for
Enjoyable.
people to do this, it's just a fun exercise. So Matt, let's get going on that
Yeah.
exercise, and we'll weave in while we have this exercise some of the things that happened in that specific area in the market this week. So we'll intertwine that into the analysis. But Matt, gonna start off right up top.
All right, let's start off with the S&P 500 itself, and again, what I like about this exercise, it allows us to understand what has happened year to date in the first 6 months of the year, but also to get an understanding of what you kind of are looking at going into the next into the back half of this year as well. The way I see the S&P 500 is really, really simple. It's been an extremely consistent bullish uptrend. You've had two bullish uptrends in the short term. The intermediate trend, the primary trend, is also bullish. You have two flaws in the analysis from a consistency perspective. You did have one standard pullback that I would describe in late March, April of this year in the S&P 500. That is not abnormal for the market. We typically get two or three of those types of conditions throughout every single year. And so you're not going to knock it for having a little bit of a minor correction. Those things are needed to maintain some degree of consistency throughout upward movements in price. And so you look at the environment from the S&P 500 perspective, and it's up 14.5% year to date. That is a really good number when you're talking about a 6-month performance in the 500 stocks that represent the S&P 500. And so when you're looking at this trend, when you're looking at the performance, I think you would give this an A minus type scenario, given the fact that 14.5% in 6 months is honestly, most people would take that if it was the entire year. And so it's obviously had a really good performance. Now, Mark, I gave it a B. And the reason I gave it a B, despite the consistency, despite the relative outperformance in comparison to historical averages, despite even the pullback, which was very consistent, I did knock it down a little bit. And the reason I knocked it down a little bit was because of the conversation that we've had all year long regarding the breadth of the marketplace, and specifically in this second trend in the market, where the market was S&P was bullish, bullish, bullish. It was very different than the first trend of the market, the first of the year. This trend at the very beginning of the year was an all-everything trend. Everything was trending: oil, gold, silver, commodities, every sector in the market. And honestly, it wasn't even led by technology; it was led by cyclical. But this second trend in the market was really dominated by two specific sectors, and really one really important industry, and that's the semiconductors, AI at the top of the market in communications and technology. Those two sectors really led the charge in this second trend that we witnessed in the first 6 months of the year. And while that trend looks really, really good, bullish, Mark, you look at the rest of the market and it kind of just went into some degree of neutrality. And so when you do take into account RSP, I did have to knock it down a little bit because RSP is just kind of treading water this year. S&P 500, I give it a B. Context matters, though. It would have been an A minus if it wasn't for the context of the divergence within RSP. With that, I knocked it down to a B. What's your thoughts?
I think you're a tough grader.
A little
Like
bit,
I get it.
a
Like
little bit.
like when people grade things, you need to understand the parameters. Matt laid out exactly the parameters. It tells the story. For me, when I was going through doing my own grades in preparation for this, I there were two criteria for me. One was it easy to trade, right? And so I don't have as much depth in my grading. Mine was more, I don't care if you got AI to write your paper. Did I enjoy your paper?
Yeah.
Right? Type thing. Was it easy to trade? And what makes an instrument easy to trade is two things, both of which were really present in this really strong move. One, you know me, Matt. Like you will hear me complain when a trend goes too far too fast.
Mm-hmm.
I hate it. I find it extremely difficult when that happens because you get extended from moving average, you get into overextended. And the S&P was more in this very strong, but this grindy, and then surge. Grindy, then surge. I found that methodical pattern fairly easy to navigate. And so really high grade because of that. The other thing that's very important to me is, are the pullbacks orderly and tradable? Is it easy to see the development, right? Mm-hmm. And you and I, both here on the podcast, on the halftime report, nailed the pullback, saying, like, listen, this is not the great bear opportunity. You're coming down to the 20 weekly, you're trading sideways. I mean, ferocious for a couple of days, but became really orderly really quick. And so both the trend was nice and orderly, and the pullback was very easy to navigate. And the S&P has been very easy to predict this year because of those two factors.
It has not been a difficult ranking year for the S&P 500.
No, and so because of that, I gave it an A, right? And one might say, well, you got to give tech better, because I know that's your counter argument.
That will be an argument.
But listen, dude, I don't grade on a curve.
Listen, people can grade however they want.
I don't grade on a curve, dude. We could have lots of winners.
How would you grade the S&P 500? Because Mark, you're absolutely right. I can't argue with that. I cannot argue with the consistency of the technical analysis. I can't argue with the consistency of the two trends we've caught. I can't argue with the consistency of the pullback analysis. All of those things are accurate, but I do think context matters. And specifically the context between RSP and the divergence we've witnessed in this second trend. And again, it's not really in the first part of the market. From this point, from the point the market started correcting in early April, from that point on, Mark, you've had the S&P 500 in a very consistent bullish uptrend. Yes, 100%. Technology's been in a great bullish uptrend. Communications has been in a very decent bullish uptrend. You've had other bullish uptrends out there as well. But what you have not had is the consistency of the cyclical or the defensive areas of the market that have done anything since late April. They've all, in some degree of flatlining condition, some degree of neutral condition, some degree of downward movement in price ever since April. And since that time frame, you've had the leadership take hold, but you've had the rest of the market basically get left behind a little bit. And that's one of my big questions coming into the back half of this year is, do we see, at any point, do we see that cyclical charge again like we did see last November, December, January, February?
It would give you more confidence in the S&P itself.
It would. And so I do think you're absolutely right. And I even said that. I think if it's without the divergence, I would have gave it an A-. With the divergence, I do knock it down because I think context does matter.
Man, I feel bad for the second and third smartest kid in your class. Like it's like, oh, that star student, they're amazing, but like maybe it's the fifth smartest student. No. Like the fifth smartest student in your class, I'm like, oh my gosh, they have such a hard.
I was the guy I was never sitting in the front. I was always sitting in the back, keeping to myself, taking all my notes, and then dominating every test. But I never really I never really participated during the actual lectures of law school, quite frankly.
I participated. I was a participant. I loved. I mean, that's one of the things I loved about graduate.
I was the guy in the back with the laptop up playing solitaire.
Yeah, dude, you and I never would have like communicated, right? So
No,
all right.
You would have came to me and Frank to get our testing prep sheets. You would have came to us. We had some really, really good testing prep sheets. But okay, now moving on, Mark. I did rank the Russell 2000, and the Russell 2000, I think, is very symbolic of not only obviously the small and the mid cap index, but I also think it's symbolic of the rest of the market when we're talking about RSP as well. And so you are seeing a similar environment of RSP versus IWM. A lot of the broad market has not caught those trends that we've seen in the leadership of the market, and thus, because of the weighting criteria of the S&P 500, that consistent trend. The Russell 2000 is struggling because of one really, really important factor, and it's a factor that is so important that I don't think neither one of you and I can see that Russell and probably the cyclical areas of the market really start doing anything from a trending perspective until we get a better picture, an understanding of the path of policy. We don't need to debate that today because we've debated it and discussed it till the cows.
Yeah, no, but Matt, I think it's important to highlight, about 5, 6, 7 weeks ago somewhere, you're like, listen, these other areas of the market, and you said it here on the podcast, are not going to find a rhythm until the path of policy is clear. I've used that.
They can't. It's impossible.
And I've been like, all right, so because I think there's 2 levels of analysis here, right? How far something can go up, that's capped because of what you said. And then how far can it go down? Well, there's other things that weigh into that, right?
That's capped too because of the economic stability conversation. But we're talking about trying to find an economic growth argument. And I did the AI Gold Rush webinar this week, Mark. And if you have not checked that out, please do so. We had a lot of fun on YouTube this week. But Mark, that was based on a very aggressive growth argument, and a growth argument I buy into 100%. How do you make a growth argument in IWM when you do not know the path of policy and you do know these companies are struggling with where interest rates are currently? When you're talking the Fed, the central bank, the interest rate conversation, the inflationary conversation, all of those are vitally important, but they're not vitally important to Apple, Nvidia, Google, Amazon. They're not vitally important to the companies that are nation states with moats the size of kingdoms. And so it's more important to these companies that are more reliant on things coming in, sales coming in, revenue coming in, hitting their numbers. And it's very hard to project where these companies' earnings are going to be if you do not have a better, more clear path to policy, because if you can't project where the future numbers are, you can't price it in. And if you can't price it in, it becomes a very difficult conversation.
And the end of this week, Bostic on Thursday did hey, we might cut, we might hike, we might do nothing. Another Fed speaker said, we're going to go at our pace in fighting inflation.
And I was gonna do a let's grade the Fed, but I didn't want to just.
No, this was going to be a fun podcast. We don't want to
listen. What you just said about Bostic would make me grade the Fed an F.
I would give the
year long.
I would give the Fed an absolute F.
We may not hike. Oh, we're going to need some data. Oh, we're going to need more data. Oh, I don't know. We could hike. We could not. They're all over the board. They're absolutely all over the board. And what they should do is just shut up. Stop giving speeches. They are not helpful. They're not clarifying anything. They're not helping the conversation.
In fact, Matt, you saw Jim Cramer recently go off on the Fed for that thing, and if Cramer's talking about it, because he's not exactly a big Fed,
he's not Fed hawk.
And then obviously people are getting tired of it. Right. They're just.
How long have I said I could care less what the Fed says?
No, once again, Trading Justice podcast ahead of the curve, right? Not a shock there.
So I would grade the Fed an F for that. But because of that, you have to you have to tap out on IWM in terms of how far this thing can go. And so you just got some wide range neutrality. I gave it a letter grade to C. Where do you come in?
Yeah, CC minus, and the same thing. This has been a very tough one to trade. There were some good trading opportunities at the end of the year. I've actually, in the last couple of weeks, started to do a little bit more with IWM, but this has been very tough to trade. The swings have been pretty big, hard to catch.
Random volatility everywhere.
Yeah, and so this one has been like, if you get me talking, I might even lower it to D plus, just because tradability is really high on my personal grading card. I have found it difficult to do more than watch for good chunks of the year. So C minus for that reason.
I think I could be convinced into a lower grade than a C, because you're absolutely right. The consistency and the volatility has been absolutely everywhere. But at the end of the day,
and not just in trends, like from day to day. Like gap up, gap down, gap up, gap down. It's
been an extremely difficult area of the market, in my estimation, for short-term trading.
Yeah,
it's just, we haven't even looked at a lot of it, honestly, in the first half of the year, because it's been all over the board a little bit. All right, let's move on. Let's talk a little bit about the sectors, Mark, and I'm going to go through these a little quicker here in the sector conversation. Technology is the #1 sector ranked at tackle trading. It's been that way for the better part of the last I'd say about 5-6 weeks now. Technology has led the charge year to date as well, up close to about 25%. It's obviously been driven through the AI trade. Yes, check out that AI webinar I did on Wednesday on our Tackle Trading YouTube channel. It's called the AI Gold Rush. You're going to want to understand that growth argument. I can promise you that. Mark, because technology has been the #1 sector for us for most of the year, not for the first part of the year. For the first part of the year, cyclical areas of the market were ranked higher than technology, but technology has really taken the charge. I give it a letter grade of an A minus, Mark, just due to random volatility has kind of been part of this conversation. It hasn't exactly been the most consistent trends out there, but because the relative outperformance and the growth, you have to rank it as the highest sector in my estimation. I give it an A minus.
Yeah, I give it an A. Just because I haven't had a losing cash flow trade on tech all year long, with the exception of maybe Intel. I'd have to look at my books on that to see if I'm break even or not at this point on that. But once again, same basic things with the S&P. We had the pullback. It was orderly. Sell-offs have established support levels that were easy to see on intraday charts fairly, and one might argue from a delta perspective, the moves have been stronger. I'm not really a big delta guy, but when you have got signals, they've produced much bigger payouts, right, than other areas of the market. So cash flow on it's been really nice. The delta has been really nice. The predictability has been really nice, and anytime you've had a sell-off of any significance, you've established a support level fairly quickly, which makes the decision making on positions easy, right? Because on a sell-off, it's such a big deal to me. On a sell-off, you're like, all right, is this going to go further? How do I manage? And then when you put in those support levels, you're like, oh, I don't have to make a tough decision here. Right. So
the only drawback is the consistency of trend analysis out there. I would actually say the S&P 500 itself is a more consistent trending environment than the actual technology.
Yes, I 1,000% agree.
It's just that there is context to the RSP SPY conversation, and the leadership here is out of this world. It's not just the 24.9%, it's the leadership out of technology that has just been absolutely standout, no doubt about that. Obviously led by NVIDIA, a bunch of other AI names out there as well. Mark, communications, quietly has been right there with communications all year long. The difference, I would say, is communications has actually been a little bit more consistent than technology in the two trends it's caught this year. But the performance right there at 22.5%, so slightly under the overall performance of the tech space. But from a consistency perspective, I would say it's slightly more consistent. Neither one, I would say, is the most consistent trends, but I'm going to give it an A minus. Pretty good, consistent trends. One bout of volatility that was market related. Outside of that, it's been a pretty decent year for communications.
Yeah, I gave it an A. Like, you want to come to Professor Mark's class?
Yeah, we'll see. We'll see. These are the easy ones. These are the leaders.
Yeah, like, and once again, everything. Once again, consistency, order, and pullback. And man, this is an area I've missed out on a little bit in the last couple months. I've had a really good couple months, but I haven't been focused. I when I was doing my grade, I was like, that trend the last couple months has been so beautiful, like just easy, methodical. I mean, you come down to the 20-day and just get a little. I mean, it's been gorgeous. It's been gorgeous. That's a beautiful chart for a 6-month time
Man,
period.
I love how theta traders describe charts.
You know,
I love it. It's like you guys just don't need the pristine technical
no,
environment.
we just don't want. And this is a thing we could do a whole podcast, Matt, on. But for a theta trader, I'm like, don't make me make tough decisions. Right.
And for a delta trader, I'm like, you better be clean. Like,
yeah. And for a delta trader,
I've always described it, Mark, as the theta trader from a technical perspective. It's all zone. It's
zone defense. Yes, we don't play man to man.
No, and the delta traders, we stick on that. We like to play a little bit of man to man. All right, but we're in line on the communication grade. All right.
Yeah, I mean, and however you want to break down the strength of the market, whether it be S&P, tech, communication, these have been orderly, pretty good trading environment charts.
Right? Especially in comparison to some of the discretionary charts out there.
Yes, absolutely.
All right, let's talk a little bit about discretionary. Discretionary has been challenged with the concern of the consumer all year long. Would you agree with that?
Well, Nike had earnings Thursday after the bell, down 20%. Walgreens down 22%. Levi down like 20%. Like, consumer-facing stocks have, I mean, just this week, I don't have to go back in history. Just this week, 3 stocks down 20% on earnings day, consumer facing, all of them. So
yeah, discretionary had a decent week actually.
And yeah,
that's an amazing thing. But then again, discretionary is an index basically of all these good retail stocks, not so good retail stocks, some hit, some miss. But it from a sector perspective, it just really hasn't caught any trends. You really haven't caught any consistency in trends. The opening price this year was right around 178 and a half. We're currently at 182.40. We're up 3%. We could easily be down 3%, up 3%. It hasn't had any consistency to it. And it's most likely based on the concern on the consumer side of the equation. The consumer has held up. No doubt about that, but they've been tapped out based on the inflationary situation. All the discretionary money that oftentimes goes to discretionary stocks, it goes to the food-based companies, right? It goes to the energy companies. It goes to where that inflation is really impacting the consumer. An open question coming into the second half, Mark, because I do give this a C, and it just hasn't done a lot. Similar to the Russell 2000 in the sense that wide range neutrality hasn't really done a lot. The difference between some of the charts that we've looked at so far and the conversation on the Russell 2000 is you got a clean resistance level on discretionary that you can basically say, you know what, as long as you stay underneath 185, we're going to have a little bit of concern. But this is an area, a little bit of the dogs of the Dow theory here, Mark. This is an area that has underperformed the other aggressive areas, and rightly so. We've been having the inflationary conversation. Interest rates are in restrictive territory. Inflation is a problem on the consumer side of the equation. Consumers have been tapped out on the credit side. All of that is true. All of that is why the market's only up 3%, despite the S&P up 14.5%. So the question is, can we play catch up in any capacity in discretionary in the second half of this year? And fundamentally, economically, geopolitically, politically, I have my concerns on that. But from a technical perspective, Mark, this is a chart, especially when you start looking at the weekly chart on discretionary. This is a chart that has the ability to play a little bit of catch up. As you can see, you're just kind of flat range, wide range neutrality. But when you pull it out to a weekly chart, Mark, you see that porch, that's a mid-tier breakout with a clean environment on top. And so, yes, it does get dinged from a ranking perspective. It has not had it's had an average year. It's up 3% so far. I give it a letter grade C, but it is one of those areas that if it does break out, you could see a little bit of catch up. What's your thoughts?
I gave it a D because all I see are V's. I see V's. I see V's on the chart. Just V-shaped rally, big sell. I can't do anything with that, right? Like it's an interesting story, and there's so many interesting stories underneath this chart, right? Like, you have some retail companies doing just fine, right? In fact, doing
really
decent,
really good.
So so.
By the way, Amazon in this space just broke out of a multiple time frame.
Oh yeah, Amazon's like just
Tesla's threatening to actually start doing something for the first time in a long time.
And so like the individual components, I think range from lots of A's to lots of F's, right? And that's what's
like, you've had A's and F's here, and it equates to a C,
right? And so the sector as a whole, which oftentimes is I don't know, Matt, if I ever can remember a sector having such wide divergence within the sector itself, as you have in discretionary right now.
There's been a couple instances in the last couple of years, specifically within discretionary, where you've had a massive separation. I think about some of those ASO, ELF, so you got the ELF, ASO, Abercrombie trends from last year, right? Mm-hmm. Where you had just beautiful uptrends. And in that same time frame, you had, retail companies, department store type companies, mall type companies, those brick and mortar commercial properties, they were just getting absolutely slaughtered. And so I don't know if at this point that the separation within discretionary is more today than it was last year, but it's certainly an issue.
Yeah. And so, the sector, there's been some very tradable things on both sides of the equation. Starbucks, it's been my favorite pick in rapid fire in our tackle trading newsletter for 3 straight weeks, consumer facing. But there's been some companies that I like, Elf Beauty, right? Like, that I just am amazed with more and more as time passes. So very interesting behind the scenes, but just on the sector itself.
I know this might be a crazy comment here, Mark, but I do want to get your take on it. I do think discretionary was easier on Delta traders, despite the volatility here, than it was on Theta traders.
Oh, absolutely, because Delta traders were able to capture trends in the individual components doing well and be like, yeah, this is a great trend. We're going to go and have really big performance.
Thing because I can describe very consistent bullish uptrends within discretionary, and I can describe disastrous situations on the directional side within discretionary. So quietly, it has been a decent Delta environment.
Yeah, I mean, it really has.
Especially if you take into account some of the shorts out there. But from a Delta perspective, it is the one area that has a clean multiple time frame situation in the aggressives. Right now, communications, technology, they're in some degree of trend.
Yeah, and keeping an open mind if for whatever reason, for example, we have the unemployment report this week, right? Yeah. If jobs miss big, like for this time or whatever, the Fed's going to start cutting. Mm-hmm. They're going to start cutting, right? That provides some of that clarity, things that maybe from a sector perspective have been waiting.
There's a bunch of retail companies, Mark, that are struggling because of high interest rates. Yes.
And so ironically, worse economic news on consumers could be the rallying cry
consumer.
For these areas that have been, fighting for some direction.
Well,
So,
and again, I know we're talking concern on the consumer, but in that time frame, Mark, the consumer discretionary space has actually been in a fairly consistent short-term trend as it's coming into that 185. You're seeing upward movements in price. What do we get, 2 days down before a big upward movement in price here? And so I do think it's something we got to keep an eye on. And again, the leadership is really strong right now. Amazon just broke out of a multiple time frame perspective. Tesla's starting to show a little bit of bull horns out there. So it will be interesting, but I think we both agree on the letter grade C and a little bit of caution unless we do form up into a breakout type situation. All right, let's talk a little bit about the cyclical areas, Mark. Energy, obviously, we talk a tremendous about. It had a tough start to the year with a little bit of downward pressure on price, but found its footing extremely quickly. And we loved that bullish uptrend within energy when in March and April, Mark, when the market was starting to show, a little bit of volatility. Energy just caught fire here. It was an awesome, awesome trend to ride. And then it reversed and formed a very consistent downtrend all the way down into the 200-day moving average. One bullish uptrend, one bearish downtrend, but now you're looking at a reversal analysis coming into the second half of this year. And so you're going through reversal analysis. I think energy is an area we should focus on at the beginning part of July as we kickstart that second half here, Mark. I do give it a letter grade of a B minus, given the fact that we have had one uptrend, we've had one downtrend, both of them were consistent. Now let's see what happens first. Energy is one of those areas of the market that I think can improve its letter grade a little bit more aggressively than the others.
yeah, I actually gave it a B plus for those. Once again, grading on some different things.
Mm-hmm.
It was, I felt that the start of the year environment was very easy on oil. I felt that most of the back, in fact, I would have given it an A if it wasn't for the last couple of weeks with oil V-shaping. Like oil V-shaping has been like, oh, wait, what are we going to do here? Right. But like I found let's get involved. Let's get involved. Let's get involved. Oh, let's not get involved. Let's not. I mean, I found that very, very straightforward. And it's very interesting what comes next here. Right. Like, my rapid fire pick this week was Oxy. Right. Warren Buffett's favorite. Right. Starting to set up. If oil can hold the breakout and if you can avoid a recession, right, which is you're probably going to avoid a recession, right, that sets a decent cash flow backdrop with some directional up. And there, once again, there is geopolitical risk out there, right? Not a huge fan of OPEC's decision, right? I think that adds some future muck
it's indecision. It adds indecision into the elements, and it's not good. But again, I think we need to realize that it is a long-term storyline of what OPEC did a few weeks ago. And so does it have an impact in the short term? Probably not moving forward. Obviously that volatility was there, big down, big up, but moving forward, I think we track oil based on the standard approach of, all right, what's the economy doing? What's OPEC doing? What's the oil rig numbers coming out on a week in, week out basis? But in terms of the reversal here, there's no area of the market that is currently reversing, none other than energy. Everything is either in a bullish uptrend, technology, communications, sideways neutral trends. This is the one trend that was to the bearish downtrend side of the equation. And it's the one area of the market that is going through a little bit of bottom up analysis, meaning reversal type situations. I don't think it comes to a proper conclusion this week, honestly. But Mark, if you do break out a 92, that's where you start getting into a little bit of open air. A week of development here would go a very long way.
Even a pullback down to support and hold and then launch from there. There's a lot of ways this can play out where,
especially the deeper retracement, Mark, that pivot at 88 is like in cement right now.
Yeah. So, ease of markets.
All right. Industrials, Chucky. Industrials a really simple one, honestly, and it's actually a very clean environment. You had a very consistent trend that was going on as we started this year. It was one of the more consistent trends we've seen this year, with it riding the 90 MA for about 3 consecutive months. But ever since we talked about in April, when the market started going through a little bit of volatility, it just has not had the ability to break out of the intermediate range it's currently in, with pivots at 126 and right around 120, 121. And so when you're looking at the totality of industrials right now, good bullish uptrend in the short term to start the year, short-term neutrality throughout the rest of the year. I did have to bring that down to a letter grade of B, but it's been consistent out there, Mark. It was consistent. It's been a stay away for ever since the double top at 126. And so it's not necessarily a directional environment right now. But again, it was consistent throughout the first of the year. It was, even in the neutrality, the pivots are very, very consistent. And I think you have to grade on a curve on that consistency. So I do give it a letter grade of B. How do you see it?
Yeah, I really don't have anything to add. B, same level of analysis. We can go to the next one because I don't have anything to add on to that.
Finance, I'm going to rinse and repeat what I said against the industrial space.
And I'm going to rinse and repeat what I say after what he says.
Yeah, I have these things running on the exact same gasoline. They're on
the same algo program is controlling both of these.
Yeah, and quite frankly, when you're looking at what can propel the financial areas, what can propel the industrial areas, I think it's a little bit of the same thing that might propel the actual RSP to, improve that divergence, or the IWM to pick up. I think it's path of policy, quite frankly.
Yeah, I mean, we got a lot of areas that are now in the path of policy type environment.
For me, the path of policy is impacting everything in the market. But if you were going to tell me what sectors are more reliant on the path of policy getting clarified, I would say cyclical above defensive and aggressive. Would you agree?
Yeah.
Okay. And specifically in cyclical, finance and industrials in head of basic materials and energy.
Yeah. And these charts are gorgeous cash flow charts. I've started to increase cash flow in other areas of the market. Remember, because once again, I'm totally on board with Matt. Like, I am not afraid of missing out unless I get a catalyst that's going to be very easy to see. Yeah. I'm also not terribly scared of the next bear apocalypse, because I don't think the market's in the mood to make that big move down. And so, like,
I'm not in the mood to make an argument that the economy's rip roaring or the economy's tanking. Like,
yeah, and to be honest, and so Matt, the macro, the Fed policy, and the charts are all lining up for some neutrality.
We're in a 2% GDP environment with 2.8%.
Matt, it's not a surprise over the last couple of weeks. I run this practice journal, Cash Flow Vikings, all-time high, just like almost seemingly every day or every other day, a new all-time high, because this is a fantastic cash flow environment.
Because all you do is let the theta bleed throughout this entire neutrality.
So increase theta, let it bleed. It's been a really good. It's been a good stretch.
Love those theta traders in that neutrality. Jackie, basic materials a little bit of an underperformer against the backdrop of the other cyclical areas. It had one really, really, really fantastic trend in early February throughout March. But ever since then, it's been wide range volatility everywhere. It hasn't had any degree of consistency. You've had a lower levels of resistance, and now you're hoping that 88 holds. But if it doesn't, it could get a little bit lower down to about 86 here. So keep an eye on 88 when you're looking at the material space. Doesn't mean it's going to break. It means we have some concern. I got this as a C+ mark. It has not been the greatest environment. It's been, especially when you're talking about the GDX components, it's been a difficult covered call year in GDX. Making decisions to open up risk graphs, making decisions to leave it open, when to lock it down. It's been a little bit of a difficult year when it comes to basic materials, and specifically the covered call within the gold markets, making those decisions. So I'm going to give it a C+. What's your thoughts?
C+ on the space. Cover calls have been a little bit easier for me because I generally don't go for much delta unless I'm like sucked in. So it's been a little bit.
That's a personal problem on my end.
Yeah, that is a personal problem on your on. I found cover call because I'm like, oh, if it goes to the moon, that's fine. I'll collect my credit. Yeah.
And I micromanage it.
And I think you maybe micromanage it a little bit where I'm like, yeah. But
I do manage covered calls in GDX a little bit more.
But yeah, C plus. This has not as been as easy as some of the others. Like ironically, even though energies in a worse spot have found that easier to manage
I've
as
had a
a
much
whole
better year on energy than
the basic materials. I haven't found a lot of
not
great
including
opportunities.
gold.
Yeah, gold is like in materials, but it's separate. So I haven't found a lot of great opportunities. Haven't been stung though. So C plus, like maybe even a C because just right. Like I'm not impressed with your work, student. But I don't have anything to fail you on. So I got no bitterness. Just another path to policy, another macro chart that's going to have to play out here.
Yeah, my face got ripped off one time on a covered call. And I wish I would have had the covered call on another time. But outside of that, you are right. It hasn't been a year where you've had to constantly manage that, but because because momentum was sparked out of nowhere a couple times, it did catch a little bit. So in overall performance, we're down 2% on the year so far. Actually, I think that's actually positive 2% on the year so far, excuse me, but I do give it a C plus. Utilities up 5% on the year, Mark. Man, utilities have been a weird ride, honestly. Big momentum out of nowhere, giving it all back. Tough train to ride, honestly, when you're talking about utilities. I would not have been as aggressive on the ranking with the C plus if it was, say, technology, but I just utilities, when the momentum comes out of nowhere and everybody gets left behind besides algorithms, it's just not a great trading environment. It's a decent year so far, up 5%, but I didn't see it as a good trading environment, and probably a little bit of a worse trading environment than the current trend suggests. What is your thoughts?
I give it an F. This is the only F I have. It has, and maybe it's my own limitations, right? Maybe I haven't adapted to utilities, maybe playing a bigger role in the AI space moving forward.
I'm
I'm
an AI guy, and I wasn't expecting that type of movement.
And so, like, we understand data centers are going to require more power, right? And there's going to be more data centers, and there's going to be more need for power. Mm-hmm. And so maybe it's my own limitation at like ability to see markets pricing in, but did they really price it in if they've already given it all back? Or is there just some funky business going on? I don't think
anybody knows exactly what utility companies are doing with the AI infrastructure build out. I think there's a lot of unknowns on that.
So is that the toughest chart you'll ever see? No, it's not.
No,
is it the toughest utility chart that you'll ever see? It's up there. It's up there. And so a space where I'll sometimes do some things. I haven't known what to do. And I've been tempted to do some wrong things. And I haven't succumbed to that temptation, but I have been tempted that would have got hurt. No, F. You gotta
stand your F, but I just can't get there with the up 5% on the year. I mean, if you're thinking about utilities in general, and you just wake up 6 months later, and it's like, oh, my utility position.
Dude, is up 5%. And this is the difference in teaching. Something could be down 27%, and I might give it an A if it was consistent.
Well, because you're seeing it from that trader's perspective. And when you're looking at utilities and the momentum comes out of nowhere and it leaves everybody behind, and then everybody's
and then all of a sudden, and then violently reverse
on utilities.
I don't want to have these conversations on utilities.
No.
If this chart is SCMI, fine. Right.
Although I do think your F is absolutely crazy. I do think the F is crazy.
F. Lionel Richie does not like utilities.
You don't like Lionel Richie.
I love you, Lionel Richie.
Consumer defensive, XLP. The consumer has been an issue. Consumer staples is actually doing a little bit better than the consumer discretionary space. But Mark, as you do look into the second half of this year, you got an improving condition on discretionary. You got a deteriorating condition on staples. You got a multiple time frame breakout on discretionary. You got an M formation forming on staples. And so the analysis would actually lead you to think or to really kind of watch that 185 breakout on consumer discretionary. following specifically Amazon's breakout. Here, staples just not a good look in the short term. And so I did knock it down because of the M formation a little bit. It's been a decent year so far in consumer staples. This is not an aggressive area of the market. Bunch of food-based, dividend-paying value companies live in consumer staples. Obviously, Walmart's been a pretty decent stock out there, but in general, a lot of neutrality in this space, and it's going through some short-term volatility at the top of a chart. Looks like an M to me. So I did knock it down a little bit, gave it a B minus. Not an area I'm looking at going into the second half as of right now.
Yeah, I gave it a D plus. I found it a very extremely hard environment to trade. A very hard environment because consumers are stressed a little bit. Certainly, certain segments of it, right? And you've seen some things in consumer defensive stocks where, like, listen, certainly some selection process. I find that extremely difficult. I found it hard to find environments that I've liked, right? Like, find me one consolidation pattern that really formed during the course of the whole year, right? Like, there hasn't been one, right? There hasn't been.
And honestly, when you know the space, it has not been the stocks in the space have not been great trending stocks.
Because unlike consumer discretionary, where there's been some rock stars, right?
You've only had a couple out of staples,
and so this seems to be a true space thing as much as anything.
Yeah.
So I've just found it just a difficult environment. Defensives as a whole, I found just very uninteresting.
All of my worst grades are in defensive. Like all of my worst grades are in defensive. So let's go on. Healthcare here. Healthcare, healthcare is up 7% on the year. It's kind of kissing into those high prices of this year. You do have a similar situation where you do see a 148 number where that is a multiple time frame resistance level that you could anchor against on a breakout situation. And healthcare could see a little bit of love above that number, but I do think it's important to break out of that number before you get way too aggressive here. Mark, I gave it a C plus, less than consumer defensive, consumer staples, because again, I just saw a little bit more wide range volatility here. There was a couple moments this year where volatility truly came out of nowhere, and now you're kind of working up into that top pricing where you need to see a breakout as well. And so it has a multiple time frame that could see some improving love above that 148 number, but until then, I kind of gave it that C plus range.
Yeah, I have found these areas totally uninteresting in 2024.
It has not been the year of the defensive.
So I gave it a D plus as well. Along with that, the defensive section, like, everyone thinks, Professor Mark's a great teacher unless you're a defensive sector,
and then he hates you. And then he hates you.
And then I hate you.
There's some bias. There's some bias. There's some old work there that you didn't like. Mark, last sector here.
Oh, I didn't let XLRE in class.
Sector here is XLRE, and yes, and
not a real sector.
Until the S&P changes the categorization, it is a real sector. Real estate has been, in my estimation, one of the hardest sectors to evaluate this year. It's been absolutely all over the board. We're down 5% on the year, and it probably should be down a little bit more than that. It's been I didn't give an F because nothing went down 20% so far. Nothing has gotten smoked from a long-term investment perspective so far this year from a sector, but this is the worst performing sector. And I don't see a lot of where it could start improving in the back half of this year. D plus, you agree or not?
Yeah, I didn't allow it in class, bro. I didn't grade it. I'm not. I'm not supporting this sector.
Not getting a grade.
Not getting a grade.
So
that's all.
So okay, so your highest graded sector was the market, tech, communications.
And energy sneakily behind it, but all of the cyclicals, the patterns in cyclicals this year, as a general rule, have been very tradable from a cash flow perspective, from a delta perspective, and a lot of them. I think you've had far more. This defensive little thing leaves a little bad taste in my mouth. But overall, trading from a cash flow perspective, from a stability, from a pattern perspective, technical analysis has been an amazing guide. And then you weave in the macro analysis we do here on the podcast and assisting positioning decisions and strategy selections and portfolio allocation percentages. It's not been a bad first half of the year in the markets. More winning trades than losing trades type environment.
Yeah, my final thoughts on the ranking, on the letter grades for the stock market here. When you're looking at the aggressives, communications technology has been perfectly fine, standout sectors year to date. Open question: can discretionary play catch up? That is an open question that I have. That
do you have it as a path of policy area?
I do not have it necessarily as the same path of policy as I do some of the other areas of the market, like finance, industrials, IWM. No, I do not have.
Is that because of Amazon and Tesla?
That is because if Amazon and Tesla take charge, you're going to see a run here in discretionary, and that could carry some of the other stocks
Fair enough.
in that area of the market. So I don't necessarily
because Amazon and Tesla are on the weighting of the sector, huge percentage. Right? They
can't. Don't get me wrong. Would clarifying the passive policy help out a tremendous amount of stocks within discretionary? Of course it would. But I'm not necessarily for me, Mark, until I have a better understanding of the path of policy.
And I'll give you a graphic example.
Interest in finance.
Yeah, Matt, Nike would not have gapped down 20% if we were on a Fed cut plan. It would not have.
No.
Would it have gapped down? Sure, right? Their revenue sucked.
But not like that.
But not like this, like Armageddon type environment that a lot of
worst gap in 20 years, Mark, on 8% drop in forward guidance.
Yeah, you think about this, Walgreens hitting, whatever low, and you'd be like, well, maybe it's just a Walgreens story. Maybe. Nike, worst move down in 20 years. Levi, worst move down ever, right? These headlines point to the unsurety of path of policy.
It's the both, right? It's the uncertainty of the path of policy, and then there's some individual problems within those companies themselves. So it's a little bit of both. But I have again, I think industrials and finance, I think RSP and IWM, specifically IWM, I think ARC to a certain extent, not completely, but to a certain extent, all of those areas of the market would improve in my estimation if there was a more consistent understanding of the path of policy. And again, I think the Fed could clarify the path of policy.
They're afraid to, Matt.
If I could clarify the path of policy and identify exactly when the Fed should start doing that, the Fed knows too. So I don't believe anything the Fed says. I think they're gaslighting beyond gaslighting. You think political gaslighting is bad in 24? Think about what the Fed has done in the last year. And so, no, I don't think it's reliant as much as some of the other spaces, but would it certainly help? Yes, it would certainly help. I think you would see if we had clarity on the path of policy, I think you would see a lot of the areas of the market that have not performed such as to the degree of technology and communication. I think you'd see a lot of shoring up in a lot of the areas that have not participated as much.
Yeah, absolutely. Now let's get to the fun stuff.
The commodities?
Dude, I'm a commodity.
All right. Let's get into the fun stuff here, Mark. And I didn't get any slides, so we're going to do this off the cuff here, Mark. Let's talk a little bit about gold. Chucky, on the gold side of the equation, obviously we both have a little bit of rosy-colored glasses on when it comes to gold. But I am very impressed with the defensive nature of gold in the sense that it's held up at an all-time high pricing, despite the S&P 500 being in a bullish trend, despite it being a growth argument being played out in the market, despite everything we've seen, gold has held up really, really well. Gold is up. What's gold up on the year so far? Let's get some actual numbers here, Chucky. So when you go to FinViz, let's look at kind of our futures here, and let's look at the commodity baskets very quickly. There's your metals there. Let's look at the performance here. So when you're looking at the performance year to date, Chucky, you got let's find your important metals here, and let me get a nice little line there. All right, gold's up 10% year to date, copper's up 11% percent year to date. What's your thoughts on gold specifically?
What's your grade, dude?
My grade is a B.
Yeah, the thing I enjoy most about this podcast that I'll maybe ever get again is that I don't have to go first on anything.
No, you don't.
Now,
My grade is a B.
Now remember, my two things that I enjoy the most are predictability, and then how and predictability, right? Gold has been fantastic, right? Like the start of the year, you just at the end of the day, Matt, for me it's about tough decisions. Does the trading instrument put me in situations I've had to make tough decisions? And I can't remember of a single time it has, right? You've had red candles, right? And then you're like, oh, is this? And then it doesn't, right? And so and so you just haven't had to make tough decisions, right? You haven't had to pay. And Matt, the plain and simple fact is, any commodity that goes through a 4-month consolidation pattern is going to get a really high letter grade for me, because everything I do, a 4-month consolidation, where support levels hold, it's fantastic. But it's been so impressive. The story for me of the 2024 has been, whether it was at the start of the year, right, or lately, gold refuses, no matter what the economic data is, no matter what the macro is, no matter what the stock market is, follow through on any selling. It just refuses to do that. Refused to do that at the start of the year. At a different point, okay, let's go way, 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 way up, and let's have the same behavior. Refuse to sell. That has been amazing, right? That has been amazing. So I'll give it an A, because of my own selfish, it's treated me very well. Hasn't really tempted me except when it should, right? On breakouts. You should be tempted on a breakout. You should do something on a breakout, right? And on those breakouts, got nice price movement, consolidate. Like, from a cash flow theta guy, I got no complaints.
I got it as a B plus. From a technical perspective, from a behavioral perspective, this is an A plus for me. Like, there has not been difficult decisions in the gold area of the market. We've had one trend, two neutral trends. Both in the neutral trends were extremely consistent against 2K and 2100 and 2300 and 2450. We called the top at 2450 with the double wick top there. It's our gold analysis all year long has been spot on, just absolutely spot on. In terms of the consistency of the technical levels and the technical analysis, I give this an A. It's my highest letter grade on that front. It has not been a difficult environment to analyze. Could it be a little bit more difficult in the back half of this year, Mark?
Well, I mean, it could. Okay, for example, we had an unemployment report this coming Friday, right? That's a big economic event, right? Like, gold has shown. Now, we've had a lot of weak economic reports lately, right? Gold really hasn't rallied on those. It has sold off on the few really strong economic reports we have, right? So is there some more than 1-day correlation if the economy actually does start to improve somewhat from a reporting standpoint? Maybe, I don't know. Could you see some weird volatility due to Fed policy actually inflate? I don't know, right? Like, so could it? I would bet no, right? Like, right? You keep an open mind, because that's what we do. I still see it as a generally favorable backdrop, right? It's unlikely that the Fed hikes unless you get inflation numbers that really, really, really start to pressure up, no matter what Bostic or anyone else says. Geopolitical, we're not going to start holding hands, right? Geopolitical uncertainty is going to remain there. That's going to remain a bid, right? So could it? I guess. Does it change anything in the long term? For me, it doesn't. What about you?
I think there could be a violation of 2300 coming into our future. I do think that will be a short-lived bullish, bearish downtrend, quite frankly, because I do think there's some pent-up demand here. And you're absolutely right. The investors haven't sold, algorithms have. The algorithms have sold on slight negative misses, Mark, not vast misses economically, slight negative misses economically. And the market you ask the question, why is gold not going up then? Because the dollar is in a short-term bullish uptrend, because the slight misses economically are being dwarfed by some bigger misses internationally from an economic perspective, and some concerns specifically in Japan.
So because I was like, what's going on in Matt's head? So I think I understand now. So basically, you think the geopolitical situations other places are going to put a bit under the dollar potentially.
I think that has been going on.
But a potential another leg.
But
like,
yes, I do think that has been going on.
Now I understand your brain.
And I think it could end up violating the 2300 level in the short term. But I think it's only in the short term.
Yeah.
Because the pent-up demand that will happen on gold when that thing gets resolved could wipe out whatever short-term downtrend occurs within 2 candles. And so I don't have a bear lean on this by no means.
Because the move up in the dollar in this scenario, the move up in the dollar would be because of external, like, for example, France has elections tomorrow, right? Yeah. There's been some uncertainty there. The yen, who the hell knows what's going over in Japan? They're firing currency officials, right? They're and other things. And so, like, it doesn't take more than an event to maybe get a bid under the dollar, and once that gets going as kind of a safety bid. But that's not the
I think kind of the base case I'm working off of here, Mark, is I don't think we're done seeing the upward movement in price on the dollar. And I do think that is from an international perspective, not from a domestic perspective.
Yeah, because it's one thing if, oh my gosh, Fed's high. Yeah, it's why is the dollar going up? It's not because the Fed's hiking. It's not because of that.
It's because you're seeing weakness internationally,
which could lead to a breakout in the dollar, which would be the weakness on gold. But it's not a sustainable.
Dollar goes up based on a lot of different factors.
Okay, that makes sense to me, and it makes sense that the sell-off would also get bought up in that scenario.
And in that scenario, Mark, I see a breakout of 106 going to 107. Okay, in the dollar. If that occurs, you would have a short-term violation of 2300 on gold. And so I just feel like, and it's a cover call conversation, even on the violation on support. I just don't think it's going to be long-lived. I think we could be looking at a fake down. And at that point, I do think we could get back into some degree of bullish uptrend within gold. So I think it's a stay away for right this very second. We maintain our cover call stance. It's neutral here. But I do see a scenario coming down the road a little bit that could be fairly bullish for gold, honestly. Because again, short-term analysis, long-term analysis, right? Short-term analysis internationally, those currencies are struggling a little bit more than the US dollar is. US dollar is going up to reflect that. Because again, you're right. We've seen
because the dollar is not moving up on independence.
The dollar's not moving up on US economic value going up.
Yeah.
Agreed?
Yes, correct.
Okay, so if the dollar's going up right now and it's not going up on positive US economic data, and it's not going up on anything the Fed has done or not done, because the Fed hasn't done anything, then why is the dollar going up? Well, when you look at the currency market right now, you know the dollar's going up because of the Japanese yen is going down. You know what's happening over there with the Bank of Japan. You know what's going on in Europe. And so you're having a slight, you're having a geopolitical uncertainty moment in Europe with the French elections. Anytime you have uncertainty, those currencies will sell, dollar goes up. Well, Mark, let's say, that we get through that European situation and we see some volatility to the downside. I just don't see that lasting, is my point.
Okay.
And so I do think we're going to see a violation of 2300. But I also don't think it's going to be a long-lasting violation of 2300. I just think it's going to dirty up the joint in the short term. And so I did give it a B+. It's been very, very consistent technically here. technically lower levels of resistance going into a horizontal support level would also technically align with my fundamental argument I just made. So it's in the short term, you could see a couple different things happening, but when you're reviewing it over the last 6 months, Mark, it's very consistent technically. And I can't ding a commodity chart in any
I do
capacity.
not know how people navigate markets without technicals. How in the world would you even do it?
I don't understand it. I don't
Like, and most people don't in the financial media and the financial landscape, right? More people do than ever have before. How do you navigate things? Like I would. Wow.
Hard. It's hard. All right, let's grade silver here, Mark.
Not a world I want to live in.
I gave silver a very similar overall ranking as gold. I gave gold a B plus. I gave silver a B. The reason I gave silver a B, slightly less than gold, despite the fact that gold has outperformed, silver's outperformed gold. And Mark, I got a wide margin by like 10%.
Oh, no, silver's had a rock star year.
And so the reason I ranked it under gold, though, is because the consistency of the technical argument on gold is really, really, really powerful. And in silver, you've just had to deal with a lot more volatility, quite frankly, in terms of the directional trading conversation. And silver is more of a directional conversation than even gold is. Now, silver is also something that interests me a little bit more than gold in the short term, though, however, as well, Mark. I like the formation here at 29, and I like the battle happening right there on that 9 weekly. So keep an eye on silver, Mark, but I did rank it underneath gold, despite the relative outperformance, because silver's had a really good year to date so far. A little bit too much volatility and trend analysis here, Chucky. What's your thoughts?
Yeah, I gave it a B, just pretty much the same. I don't have a lot of, really insightful things to add here. Like, it's just been a little crazier than I typically like an instrument, but nothing bad, right? Like, it's just the consistency. You look at just the pattern on gold is just so easy, even for a new trader to understand, right? Silver's a little more nuanced, right?
It is a little more nuanced, but I'm telling you, I do see an edge here. I do see.
It's been fighing for support. Listen, I added silver 30. This week. I went from this is how the bravery of theta traders. I went from a low delta naked put to a more aggressive but still conservative cash flow play.
There you go, buddy. There you go. Look at you.
It is a net add-on silver this week, so I see that edge. I'm with you.
We're going that delta above 30 there. I like that trigger. All right, Mark, we got two more instruments to rank here. I did not rank crude oil in the newsletter. I was going to. I just got busy. I didn't do it. If I was going to rank
my favorite trading instrument.
It is your favorite tradable instrument. It has not been my favorite tradable instrument this year. I'm going to give it a C minus, Mark. I feel like from a directional perspective, we caught that one beautiful trend.
Yeah, there's not been many pockets for direction, has there?
Very, very powerful trend in energy in February and March. Ever since then, it's been kind of a stay away for us. Been all over the place. It's also a place we're looking at going into the back half of this year, though. The first half, choppy, wide range volatility. Been a little bit of a difficult environment, but it is getting cleaned up here, Chucky. I will officially give it a C minus.
Yeah, like the first 3 months were an A plus for me. Like from a cash flow perspective, maybe even if you get in, first 3 months, right? I thought it was a great environment, coming off some, and that's a continuation of a really good bottoming formation that formed at the end of last year. Haven't done much with oil itself in the last little bit, and I have found this V, it particularly, Vs are going to get me, and they're going to piss me off. There's a reason those consumer defensive areas, I just hate them, unless they are spurred by a catalyst, right? When stuff started Ving, when Powell went all pivoty, totally get it, understand, let's take advantage of this party. When they pivot for reasons I can't understand out of a catalyst, adds a layer of confusion. So overall, I gave it about a C plus, right? Haven't found it in totality a great environment. Have hated the second quarter of oil, just hated it.
Second quarter's been absolutely terrible.
Like, just found it very difficult. I almost never lose money on crude oil. And I am, I had a losing trade on crude oil that I'll eventually try to fade away. But so I found the second half really difficult. So really good first quarter, bad second. We'll see what it has. But moving forward, Matt, I'm more interested in XLE to start this second half of the year, right? Because I just have to have oil do nothing, and I can make money on XLE components. So
yeah, I agree with that. I do like XLE, but I have not been a fan of the technical.
Oh no, it's just been sloppy.
It's finally starting to get cleaned up. It's finally starting to get consistent, but that's just in the last week, and even at that, it's big up, big down, big up, big down. So, but that's more consistent than
and Matt, you wrote in the newsletter there was a great section worth signing up as a trader alone for this section. Like, what did you learn from your mentor? Like a section on things that coaches that tackle trading, individuals. What did you learn? What are some things that you learned? Right, like one of the things. And one of the things I learned along the way is if it's difficult, you don't get bonus dollars for degree of difficulty.
No.
If I nail the most complex trade ever, I'm going to make the same amount, maybe relatively, like on the same pattern, same risk profile as a very easy technical setup. You don't get bonus dollars.
This isn't gymnastics in the Olympics.
It is not gymnastics. You don't get like triple sow cow figure skating bonus points.
And the only reason I brought up the gymnastics comment is I watched that one lady who is beyond out of this world good at gymnastics, doing like 14,000 triple jumps, flips, landing it. I'm like, wow, the degree of difficulty is off the chart.
Yeah, no, I remember
you do not get graded on a curve in the market.
And one of the favorite stories you've ever told that I've enjoyed was like you're speaking in front of an audience and an individual says, and I'm paraphrasing. I mean, it's obviously you remember it because you were there, but I'm paraphrasing. But like, why? Like, you're just showing us all the easy charts, and you're like, yeah.
I remember the conversation very, very well. He stands up and he says, "Matt, this is all great," and I said, "Thank you." And he says, "But," I'm like, "No, we'll leave it at that. This is just great." And he's like, "No. I got something to say." And I'm like, "Okay." And he says, "Listen, this is all great, but you're just showing us the easy ones." And I said, and Mark, I was teaching the same way. We pull up live data when we're doing examples, right? And I said, "I'll tell you what, I'll make you a deal. Okay. You go trade all the hard ones. I'll trade the easy ones. We'll see who makes more money."
Yeah. Like, I love that story because
you don't, the degree of difficulty is not part of the equation here. We like simple, we like clean charts, and crude oil just hasn't given you one. It really just has.
It's been a tough backdrop for a while. And so what have I done? I've traded less crude oil, right? Like, I'm not going to try
crude oil and energy has been a complete stay away for 3 months up until this current reversal situation.
Like, so yeah, just do less of that. Do more of what's easy.
Last one, and then we'll finish it up with some final thoughts here, Chucky. BTC Bitcoin, and I'll just give you my quick take here, Chucky, on the actual letter grade here, Mark. Bitcoin had quietly, it's actually up the most of all the instruments we've discussed here today.
Yes.
It's up like 43% year to date. It's had a fantastic year when you think about price performance, right? And you would say price performance up 43%, that's an A plus, right? Absolutely no disagreement there. However, we obviously are taking in the context of navigating these trends and these patterns throughout the first 6 months, right? And in doing so, Mark, you had one trend here. It lasted for about 3 weeks.
One trend with two potential signals.
And it had two signals in, one front run, one not, which means you had one. And I legitimately mean this. You had one pattern within a trend that you could have triggered from a textbook scenario. That I don't think, despite up 43%, that you can describe that as a clean environment. You certainly have to respect the 43% gain this year, but I'm going to knock it due to consistency. I'm going to knock it due to it's been living in wide range volatility neutrality for the better part of 4 months. I'm going to also knock it because you're threatening a violation of 60K here, which would give up a lot of that 43% gain fairly quickly there, Mark. So I do think you knock it a little bit, and I do think you start the back half of this year with a little bit of concern as you are dancing that very, very, very important 60,000 number as support. So I'll give it a B minus, Mark, to respect the number one asset class from an overall price performance level. But context matters as we grade things, as we rank things.
Yeah.
The context is one trend with one pattern in it that could have been triggered from a short-term trader's perspective. Good for the investors. The investors, you got an A, right? The investors got an A, but the traders out there probably rank this as a D minus. So I'm going to come in, average that out, give it a B minus. What's your thoughts?
I like, and well, if you've been following along, consistency, aspects, I gave it a D, right? And I like how you phrase that. For investors, an A, right? For the holders, A, right? Like, hey, did what you want, had some wild swings, consolidated. Actually, the consolidation is less wild. I also don't have any options on IBIT. And so I know that's not Bitcoin's fault. It's Gary
crazy,
Gensler's fault.
Like, it's crazy.
It's crazy. I am here doing a mid-year review,
guys,
and I still do not have
6
options.
months, guys. Like,
because I could do things even in a slight downtrend to skew some ownership with a slight bearish bias. There's all kinds of crazy stuff I can do.
But you know what the powers that be allow you to do?
Nothing.
Go buy an out of the money call option on a quadruple leverage ETF.
Yeah, I can go buy leverage NVDL. Let's go leverage up NVIDIA. Right. Hey, let's go do that. Let's go buy the TQQQ. Let's go do just triple leverage market. In fact, Mac, no, let's get even crazy. Let's short triple leverage through the SQQQ.
We have to teach the Chicago Board of Options Exchange and the SEC.
It's not their fault. They want
why options.
The SEC doesn't want
in the first place, though. Options exist as an insurance against asset classes. They allow you to buy put options to protect investments. They allow you to write call options to cash flow. The options market is not utilized as the casino the way some people think about on Twitter. And I do believe they are making decisions based on over speculation from the retail side of the equation, but that's not the purpose of options. And so don't hurt everybody because there's a few dumb bad actors in the marketplace. Options are made so that you can buy put options. There's a lot of ways we trade options, but the primary purpose of why put options exist is not to speculate on the downside, but to insure against your asset class. The primary reason call options exist is not for us to utilize them in swing trading conditions, but we want to sell them to bring in some cash flow to offset, directional, situations. And so I don't get it. I really don't. I think it's absolutely batshit crazy, quite frankly. And I apologize for swearing on it, but oh
my goodness. If you had Matt dropping the first swear word on the podcast, that was long odds. Long odds. I am always the one that does it. Like
I don't
that's seriously like 50 to 1 odds. I don't know if it's ever happened.
It's happened a couple times,
but I'm just saying it's long odds, right?
But that's about as aggressive as I get with my language with
potty mouth. How dare you?
I will say I do have a little bit of a potty mouth, but I do try to control.
Oh, he has a much bigger potty mouth.
The shocking thing I think for people listening is I do have a bigger potty mouth than you do.
Yeah, it depends on the day, but yes,
it depends on the subject and the day. That is true. That is true. But all right, Chucky, what was your letter grade for Bitcoin?
It's been untraded. There've been more false signals for both bears and bulls than good signals. Bitcoin gets.
There's been more fake outs than legit signals. Yeah.
And so that's a tough backdrop, and the lack of options. And I give Gary Gensler a double F.
Fired him.
fired.
Fire.
Man, like it just makes no sense. Just makes
Yeah.
no sense.
No sense. Well, that's our rankings for the Trading Justice podcast this week. We felt like it was time to do a mid-year review. And Chucky, I really enjoyed the conversation. I hope our community enjoyed the conversation as well. If you are listening to us on a podcasting app near you, appreciate you guys so much. Thank you so much for being the best part of our Trading Justice podcast. And if you're watching on our YouTube channel or on Tackle Trading Twitter feed, appreciate you as well. Hopefully you enjoyed it as well. Make sure to give us a nice little like and share on YouTube. Hit that like on Twitter, on Facebook, wherever you're watching or your viewing pleasure. Just wanted to let our community know how much we appreciate you guys. Thank you for being the best part of Tackle Trading and Trading Justice. Thank you for supporting the podcast as much as you guys have for the years and the years we've been doing it. And my last thought, Mark, is this is a great time at Tackle Trading to get all of your educational needs get dialed in. You mentioned the article I wrote in the newsletter this weekend, Chucky, on mentoring, and it was the third topic. And the third topic in the newsletter, I always start with, a technical write-up in topic number one. Topic number two is usually some degree of market relevant conversation this week. Like I'll write about earnings. This week I wrote about, the letter grades of the market and some open questions for the second half. But the third topic is usually something off the top of my mind, something I want to write about, some message I want to get across to our community. And, we're in our holiday sale season right now at Tackle Trading. And so I decided to write about some of the lessons and some of the that my mentors taught me along the way. And I've had multiple mentors. I've had trading mentors, mindset mentors, option mentors, had a Forex mentor. I've had a lot of different mentors and coaches along the way. And at Tackle Trading, we call them coaches, but let's be real, Mark. The coaching at Tackle Trading is actually mentoring. We are all mentors. That's who we are. We were all mentors with Legacy and Rich Dad. We're all mentors with Tackle. And so we call it coaching because we're Tackle Trading. We love the name coaching. We're going to coach, but it really is a mentorship. And what my mentors taught me, I mean, by no means is the list just 5. But I wanted to write down 5 lessons that I learned in my early career from my mentors that if I didn't have those mentors and if I didn't have those coaches and if I didn't have that community, I know for a fact Tackle Trading would not exist today. I know for a fact that I wouldn't be here talking about the market. And so it's a beautiful thing that what those mentors and what coaches can do. There's a lot of paths to financial success in the financial world. I don't say Tackle Trading has the only path to financial success. I do know we can help you get to achieve your goals in a faster, more effective, and a more efficient way possible. And I do know that we will help you out in any capacity that we can. And that's what really separates Tackle Trading, Mark. Our education is standout. Our coaches are amazing. Our community is fantastic. I love all the traders within our community, but it's the care that the coaches take to work with people until they don't need it. That's what Tackle Trading does better than absolutely anybody else. We will work with you until you don't need it any longer. And that's what teach a man to fish, not give a man. That's what we do in our pro membership. That's what we do in our education. And so if you are looking for that, this is a great time to sit down and get a consultation with my good friend, Coach Sylvia. And so anybody can get to that consultation link. It's right there on the storefront on the coaching icon. You can sign up. Anybody listening to this right now has the ability to sign up for a free 30-minute coaching consultation with an amazing trader named Sylvia Cook, who's been in the markets for 20 years, who can help establish a proper game plan specifically tailored for you, the individual, so that you can meet and achieve your goals. That's a great opportunity. And so I would take advantage of that. And that's my last thought for the podcast is sit down with Coach Sylvia, And even if it's just review where you're at and start putting in a plan in place, do that. Don't assume that 30-minute consultation is anything you think it is. You're going to make it whatever you want it to be. Get the help that you want. Get the help that you need. And so definitely take that step. It's going to be an amazing journey, and we look forward to working with you at Tackle Trade.
Yeah, there's nothing to add to that other than have a fantastic week, everyone. We'll catch you next week. Enjoy your 4th of July. Be safe. Be safe out there.
Happy 4th, everybody. America.